Okay, we're up to, I believe, in microeconomics, numbers 5, 6, 7, 8, and 9, correct? Is that correct? You did all of this? All right, I know it's good. We did the incidents.
Multiply we did.
Right. No, but then
Minus.
we did elasticity and incidence of attacks.
Yeah, we did.
Time.
7, 8, 9.
Yes, we did it. We did
So
it.
with this, we're left over.
Correct. Full, right, 5, right. You see, I
Right,
marked
5,
off.
6,
Right, 5, 6, 7, 8, and 9. Right. Okay, so let's talk about cost. I'm going to put a little, what you call it on the board, I'm going to put a little table on the board. And the table is going to show you a depiction of the costs to a company, right? So this is units, this is total cost, this is average cost, this is marginal cost.
Yeah, we just pull it up and out. Up and out it goes. Sorry about that. That's good. Oh, yeah, it's okay. You could pull it out. Okay, it's fine.
All right, this will be a little bit better.
Much better already.
Okay.
Thank you.
All right, so this is total cost, average cost, marginal cost. Okay, units, 5, 10, 20, 30, 40, 60, 100, 220, 360, 5, 40, and average cost. The average cost is total cost divided by units. Marginal cost means the extra cost of the extra unit, the extra cost of the last few units, which is change in total cost over change in units. So let us calculate. Average cost is total cost over units. 60 divided by 5 is 12. 100 divided by 10 is 10. 220 divided by 20 is 11. 360 divided by 30 is 12. And 540 divided by 40 is 13.5. That's how we get the average cost. Now, for the marginal cost, change in total cost over change in unit. So the first one, the change in the total cost is 60. It's from zero. It's from zeros. So it's the same 12. It's the same 12. Change in the total cost, which is 40 over change in units, 40 over 5 is 8. 40 over 5 is 8. Change in total cost 220. Change in total cost 120 over 10 is 12. 140 over 10 is 14. And 180 over 10 is 18. So the marginal cost is listed for you. Now before we go further, okay, so that's the way you calculate. Now, before we go further, let me say the following. When we talk about costs, and here we're going to discuss the issue of implicit cost. When we talk about costs, let me say the following. When we talk about costs, we mean all the explicit costs and all the implicit costs. All the explicit costs and all the implicit costs. What do we mean by explicit costs? Explicit costs means the cost of labor, cost of rent, cost of interest, cost of raw materials. Those are explicit costs. Implicit costs means you're paying yourself. In other words, I'll give you an example. You have a company and you work there. By the way, when you talk about explicit cost also includes profit, but we'll get to that in a minute. Also includes normal profits. We'll get to that in a minute. Implicit cost means you have a company and you work in this company. And this company, and you work in the company, you work 12 hours a day because it's your company. So you put in a long hours. Your wife works there part-time, kids help out a little bit. Okay, that's your company. And you own the building, and you invested initially $250,000 in this company. You invested $250,000 in this company. At the end of the year, you come home with $150,000. So you say to yourself, hey, I'm making a lot of money, $150,000, making a lot of profit. And the truth is you're making no profit. Because all the returns you're getting, all that money you're getting, are all costs, but they're implicit costs. The costs you pay yourself. For example, you're working 12 hours a day, you should get $100,000 for that easy, even if it's minimum wage. $100,000 for working 12 hours a day. Your wife works part-time, she get $40,000. Your kids work there a little bit, okay? So they should get another $10,000. There's your $150,000. Besides for that, you invested $250,000 in this company. You should earn interest on that. Let's say you're even earning, whatever it is, 5% interest. 5% interest is already a couple of $1,000s, right? 5% interest is a couple of $1,000s. 250,000 times 10% is 25, right? Is 25,000. So times 5% is 12,500. You should earn 12,500 for that. And what about owning the building? You could rent it out for $30,000 a year. You're losing money on this whole business. You're losing money. Because when we say costs, we include the implicit costs. When we say, if I say to you, for example, in this example, his total cost is $360, and his total cost is $360, much of that $360 is implicit cost that he's paying himself. Okay, so that's the first thing. These costs include the explicit cost and the implicit cost, but not only do they include the explicit cost and the implicit cost, they also include normal profits. What do I mean by normal profits? In other words, normal profits means how much it costs to get this business started. How much it costs to get this business started. What the cost to get this business started is the cost of the land, the cost of the labor, the cost of the capital, and the cost of the risk. In other words, to get this business off the ground, you've got to pay someone for risking his money. And the payment to land is rent, the payment to labor is wages, the payment to capital is interest, but the payment to risk is profit. Normal profit is a cost. Normal profit is a cost. So when we say 360, for example, again, his total cost is 360. It includes all the money he's paying his workers, all the money he's paying himself. And on top of that, it also includes normal profits. Because if there were no normal profits, this business could never get started. So when we say 360, we mean 360 including all costs, full costs, including profit, and including the money he's paying himself. So if I say he comes home after the year is over with $360, then it's fine. He's making perfect amount of money because he's getting paid all the explicit costs, he's getting paid enough for himself, and he's getting paid profit as well. It's fine. He is fine once he makes that 360. Okay, so this is the chart. Now let's take a look at this chart. As you can see, just let's investigate this. As you can see, average cost goes down and then goes up. And marginal cost also goes down and then goes up. Why is this happening? Why is that? In other words, we're using this as an example. We're using this as an example, and the example is simply showing the pattern. The pattern is costs go down and then they go up. Marginal cost goes down and then it goes up. And average cost goes down and then it goes up. Why do marginal cost and average cost go down and then go up? I'll tell you why, because of diminishing returns. We already spoke about diminishing returns, right? We already spoke about diminishing returns. You have a field, you have a worker on a field, and you add a second worker, the second worker produces more for you, but at a diminishing rate. In other words, the second worker produces less than the first worker, the third worker produces less than the second worker, and so on. But we also said that there's a point of diminishing returns. We also said there's a point of diminishing returns. We also said that this applies when the field is fixed. But if you have this huge field, and you stick one worker in one corner, and you stick the other worker in another corner, and you stick the third worker in the third corner, and you stick the fourth worker, you may not get diminishing returns. Why do you get diminishing returns? You get diminishing returns because the first worker had a whole field to work with, two workers together have each half a field to work with, three workers have a third of a field to work with, so therefore you're going to get diminishing returns. But if you can stick the worker himself in one corner and the other worker in his own corner, they both have a whole field to work with, so you didn't get diminishing returns. So the point is that you don't immediately get diminishing returns because you're sticking one worker in his corner and the second worker in his corner, but as you add workers, the field fills up and you reach the point of diminishing returns. Once you hit diminishing returns, your costs are going up, like we said. Before you hit diminishing returns, your costs are going down. That's why costs go down and then go up, because before the point of diminishing returns, costs go down, and after the point of diminishing returns, costs go up. So marginal cost goes down and then goes up, and average cost goes down and then goes up. Okay. Now another thing you have to know is this. The marginal cost curve meets the average cost curve at the bottom of the average cost curve. The marginal cost curve meets the average cost curve at the bottom of the average cost curve. Why is this so? I give the example of tests. Let's say you have a 70 average, and your next test is below average. Right? The next test is 65. What's it going to do to your average? It's going to bring your average down. Your next test is 85. What's it going to do? It's going to bring your average up. In other words, here's what happens. As long as your marginal is below average, it's going to bring your average down. As long as your marginal is below average, it's bringing your average down. Even if the marginal itself turns up, but it's below average, it brings your average down. As soon as it goes above average, it brings your average up. So it meets at the bottom. As long as marginal is below average, it's bringing your average down. As soon as it goes above average, it brings your average up. So it has to meet it at the bottom. In other words, and it doesn't matter. You see, look, marginal is below average, it's bringing the average down. Even though the marginal itself is going up. Even though the marginal itself is going up, it's still bringing your average down. In other words, I'll give you the same example of test. Let's say you have a 70 average, and on your next test you get a 10. It's going to bring your average down. Your next test, right? Next test you get a 10. A 70 average, your next test you get a 10, it's going to bring your average down. The next test you get a 20. If it's still below average, it's still going to bring your average down. In other words, even though the marginal itself is going up, as long as it is below average, it's going to bring your average down. As soon as it rises above average, it's going to bring your average up, and therefore it meets it at the bottom of the average cost curve. That's what the cost curves look like. Now I ask you the following question. We are operating on the perfect competition. That's the next item on the list. We are operating on the perfect competition. What is perfect competition? Perfect competition is a situation in which you have a large number of sellers and they're all selling identical products. Apple growers. Apple growers are all selling the identical product, and there are a large number of them. Once there are a large number of sellers all selling the identical product, none of them has any control over the price. The price is going to be set where the total supply equals the total demand, right? That's where the price is going to be set. Where the total supply equals the total demand. And no producer is big enough to move this supply curve at all in either direction. See, that's the difference between monopoly, imperfect competition, actually. That's the difference in imperfect competition and perfect competition. Perfect competition is a situation in which there are so many sellers, none of them can move that total supply curve one iota. As opposed to imperfect competition, maybe you have 2 companies, 3 companies. If one of them doubles their production, the supply curve moves all the way up and the price goes down. In other words, imperfect competition is a situation in which each of the sellers, whether he's one or one of a few, has control over the price because he can move his supply curve, and his extra supply or lack of supply will have a very, very strong effect on the total market and will move the equilibrium. But under perfect competition, there are so many sellers, and they are so small that none of them can move. In other words, you take the example of bakers. Let's say one baker doubles his production. There's a baker on Avenue J. He doubles his production. What's that going to do to the price of bread in New York? Nothing, because there are so many loaves of bread in New York, it makes no difference. That's the difference in perfect competition and imperfect. In perfect competition, there are many, many sellers, and none of them can move the supply curve at all. In imperfect competition, there's either one or a small number of sellers, and when one of them increases his production, it moves the total supply curve. So under perfect competition, we say that the firm is a price taker. He cannot influence the price. All he can do is look outside and say, what's the price? And on the basis of that price, I will make my decision. He's a price taker, as opposed to imperfect competition, in which he is a price maker to some extent. Okay, so now I give you an added piece of information. Now I give you an additional piece of information. This additional piece of information is as follows. I tell you that this is under perfect competition, and the perfect competitor looks out into the market and sees his price is 12. The price people are willing to pay for this loaf of bread is 12. How many is he going to produce? Based on a price of 12, how many is he going to produce? And the answer is, under perfect competition, he sets price equals marginal cost, and that is his equilibrium. In other words, if the price he's getting is greater than the marginal cost, if the price he's getting for this is more than the marginal cost, in other words, the seller is always looking to his costs and his benefits. The benefits is the price. Cost is the marginal cost. He's always looking at marginal cost, not average cost. This is very important. He says to himself, if I'm getting more than it's costing me, and he decides one at a time. In other words, he says to himself as follows, should I produce the 5th one? The 5th one cost me 12, but it includes profit. So should I produce it? Yeah, because it includes profit. I already said it includes profit. It includes all the implicit costs. In other words, he's paying himself for his own labor, and he's getting normal profits. Should I produce the 1st? Yes. The 2nd? Yes. The 3rd? Yes. The 4th? Yes. The 5th? Yes. The 6th? Of course, because the costs are going down. The 6th one, he'll produce, because the 6th one cost him 8, and he's getting 12. And the 7th one, and the 8th one, and the 9th one, and the 10th one. The 11th one, sure, because it cost me 12, and I'm getting 12. The 11th, the 12th, the 13th, the 14th, the 15th, the 16th, all the way up to the 20th. The 21st one, should he produce it? Answer, no. The 21st one cost him 14, and he's only getting 12. So, as long as the price is greater than marginal cost, he does it. As soon as price equals marginal cost, he stops, because beyond that point, marginal cost is going to be greater than price. In other words, it's going to cost him more than he's getting. And notice, he doesn't look at the average cost. The 21st one he does not produce. Not produce. Even though the average cost is 12. Even though the average cost is 12, he does not produce it. Because he decides one at a time. Should I produce this one, the next one, the next one, the next one, the next one? And when he gets up to the 21st one cost him 14, it's not worth it to him to produce. Even though, on average, it's only 12, but the 14th one isn't worth it to produce. Okay, so under perfect competition, we have to go further because we're not finished yet. Under perfect competition, he sets price equals marginal cost. So let's say this is the price here, right? I drew the line. This is price. He will set price equals marginal cost and produce this many, correct? Okay, you see the graph? He will set price equals marginal cost. Let's say this price is 30, and he sets it equal to marginal cost, and he produces 55 units. There, I wrote it on the board, 55 units. In other words, all these units before 55, the price is greater than marginal cost. Look, here's the marginal cost curve. Here's the marginal cost curve. Price is greater than marginal cost, price is greater than marginal cost. All the way up to this point, price is still greater than marginal cost. But as soon as he goes beyond this point, marginal cost is greater than price, he stops. But look, price equals marginal cost. This is only the short-run equilibrium for the perfect competitor. This is only the short-run equilibrium for the perfect competitor. Because look, if he sets price equals marginal cost over here, that price is above average cost. That price over here, where I drew it, is above the average cost. What does it mean to be above the average cost? It means he's making excess profits. It means he's making excess profits, because I already said the costs include normal profits. What do normal profits mean? Normal profits mean a sufficient amount to pay him for his risk. Sufficient amount to pay him for his risk. Enough to pay him for his risk. Just enough to pay him for his risk. But over here, he's making excess profits. What happens if this guy is operating under perfect competition, he's making excess profits? Well, under perfect competition, there are a lot of sellers. Why are there a lot of sellers? Because there are no barriers to entry. Anybody can enter this market. It's easy to enter this market. He's making excess profits. The price happens to be 30, and he happens to produce 55. But at that point, he's making excess profits. Another guy walks down the block and says, he's making excess profits. I'm going to join that business because it's a great business. You make excess profits in that business. And I can only make normal profits in my business. So a lot of people join the industry. When all these people join the industry, a lot of people all at once join the industry. What happens to the supply curve? The supply curve goes up and the price comes down. So all of a sudden the price comes down to 25. The price comes down to 25. Now, this producer can only produce this many. Right? He can only produce this many. Of course, the price came down to 25. But he's still making excess profits. So more guys come into the industry and the price comes down again. Where does this stop? It stops in the long run where the price comes down to the bottom of the average cost curve. In other words, the only time this process stops is when no one else comes into the industry. When does no one else come into the industry? When the excess profits are eliminated. When are the excess profits eliminated? When it's equal to average cost. So the price has to equal to marginal cost, and it also has to equal to average cost. Where does the price equal marginal cost and also equal to average cost? At the bottom of the average cost curve, because we just said that the marginal cost and the average cost intersect at the bottom of the average cost curve. So in the short run, he sets price equals marginal cost. But in the long run, he sets price equal marginal cost equal minimum average cost. He comes all the way down to the bottom of the average cost. So the short run equilibrium is price equals marginal cost, and the long run equilibrium is price equals marginal cost equals minimum average cost. This is the situation under perfect competition. Now we turn to the situation under imperfect competition. Okay. Under imperfect, so I'm going to erase this. Okay? Now we turn to the situation under imperfect. Let's take a look at the situation under imperfect competition. First of all, and we will only discuss the extreme case of imperfect competition, which is monopoly, but let us understand something. Price, let me give you another chart. I'm going to be doing a lot of charts today, actually. Price, quantity, total revenue, marginal revenue. Price times quantity equals total revenue, correct? Price times quantity equals total revenue. Because the total amount of money I make is the price times the quantity. Marginal revenue means how much I get for the next, how much more I put in my pocket, not necessarily profit, how much more I put in my pocket for the next one. So let me give you some numbers. 10, 10, 100. Now, this is under imperfect competition. Under imperfect competition, here's the situation. If I produce more, I'm going to have to reduce the price. Because I'm the only producer. If I produce more, I'm going to have to reduce the price. Like we said, if you're the only producer and you produce more, you're going to move the supply curve and the price is going to come down. If you're the only producer and you produce more, don't think of it produce one more, producing a million more. Understand? You're the only producer, you're producing a million more. Don't think of it as 10 and 10. Think of it as 10 and 10 million, but we're truncating it to make the numbers. So, if he's charging 10, he sells 10, and he makes $100. If he wants to sell 11, he's going to have to reduce the price to $9.50. And his total revenue will be $104.50, correct? His total revenue will be $104.50. And his marginal revenue will be $4.50. Now, if he wants to sell 12, he's going to have to reduce the price to $9. And under those circumstances, his total revenue will be $108, and his marginal revenue will be $3.50. Okay, so notice what happened. Notice what happened. Under perfect competition, the price is given, and as much as he produces, he never has to reduce the price. Why? Because he's a tiny part of the market. He doesn't have to reduce the price won't move. But under imperfect competition, the price moves. So now, look, let's say I say to you the following. This is his chart of the money he's making, correct? Now I say to you, you know something? He looks at his costs and he sees, well, first thing, before we get to that, look at what happened here. Look at what happened. He was making 10, and he was charging 10, and he was making $100. When he made 11, he's charging $9.50, but he's only making $4.50. He's only making an extra $4.50. And when he's making 12 and he's charging $9, he's only making an extra $3.50. How is that possible? Why is that happening? Why is it happening? He's charging $9.50 and only making $4.50. You see? He's charging $9.50 and he's only making $4.50. That's what it says. And it's perfectly reasonable. And the numbers work. Look, $9.50 times 11 is $104.50. But before he already made $100. So therefore he only gains $4.50. If I were to tell you, for example, that the price is $4.50, he would only produce this many, right? So, but I'm asking a different question. I'm asking, how come, if he's charging $9.50 for the 11th one, how come he's only making $4.50? The answer is simple. The reason why, when he's charging $9.50, he's only making $4.50, is because when he charges $9.50 for the 11th one, he has to charge $9.50 for the first 10 too. He has to charge $9.50 for the first 10. So therefore, whereas previously he was charging $10 for each of the 10, now he's only charging $9.50 for each of the 10. So it's true he's gaining $9.50 on the 11th one, but he's losing 50 cents on each of the 10. So it's plus $9.50 minus $5, and he only nets out $4.50. He only nets $4.50. And the same thing happens here. He's charging $9 for the 12th one. Charging $9 for the 12th one. So he's plus 9. But in order to sell the 12th one, he has to reduce each of the 11 by 50 cents. So it's plus 9 minus 550. Plus 9 minus 550, he only nets out 350. So you see from this that the monopolist has a little bit of a problem. Every time he reduces the price, he has to reduce the price on everything he did before. And if he reduces the price on everything he did before, he's going to make less than he's charging. So now, you see, whereas under perfect competition, we say price equals marginal cost. Price is what he's getting, and marginal cost is what he's paying. Under monopoly, he's going to say marginal revenue equals marginal cost. Because marginal cost is still what he's paying, but price isn't what he's getting. He's only getting the marginal revenue. So under imperfect competition, the equilibrium is going to be not price equals marginal cost, but marginal revenue equals marginal cost. In other words, under imperfect competition, he says to himself like this: if marginal revenue is greater than marginal cost, I'll do it. I'll even do it till the point where marginal revenue equals marginal cost. But as soon as marginal cost is greater than marginal revenue, I will not do it because it's costing me more than I'm getting. So under imperfect competition, what's happening is that he's looking at marginal revenue, not the price. Let us draw the cost curves. So, we have the same cost curves as before, marginal cost and average cost. But this time we also have to have a marginal revenue curve, because he's not setting price equals marginal cost, he's setting marginal revenue equals marginal cost. So we will draw in the demand curve, and we will draw in the marginal revenue curve. And we said marginal revenue equals marginal cost, clearly, because as long as, you see at this unit, these are units, and these are dollars of cost and revenue and so on. So at this unit, let's say the 10th unit, at this point, marginal revenue is greater than marginal cost, we'll do it. At this point, marginal revenue is greater than marginal cost, so we'll do it. At this point, they're equal. But as soon as he goes beyond this point, marginal cost, you see, is greater than marginal revenue. He won't do it anymore. See? That's what happens. Now, let us just, since I messed it up, let me redraw it. Demand, marginal revenue, average cost, marginal cost. He sets marginal revenue equal marginal cost, produces this many, and what price does he charge? What price does he charge? Does he charge this price here? No. He goes up to the demand curve and charges that price. In other words, marginal revenue equals marginal cost shows him how much to produce. And then he goes up to the demand curve, charges the price reflected on the demand curve at that quantity. Why? It's very simple, because what I said before, if you remember the chart I had before, price, quantity, total revenue, marginal revenue. I had here price 950, quantity 1150, total revenue 10450, and marginal revenue 450. Remember that? And I said, what if I tell you the marginal cost is 450? How many will he produce? Well, if I tell you the marginal cost is 450, he sets marginal cost equal marginal revenue, he produces 11. Sure, he produces 11, but what price does he charge? He charges 950, because only by charging 950 does he make 450. See what I'm saying? He charges, if I tell you marginal cost is 450, and you set marginal cost equal marginal revenue, and you say, okay, marginal cost equals marginal revenue, that means he has to produce 11. Produces 11. Well, what price does he charge? 950. That's what it says. Why does he charge 950? Because only by charging 950 does he make 450. If he didn't charge 950, he would never make 450. It's only because he charges 950 that he made 450. So therefore, he sets marginal cost equals marginal revenue. That gives him the quantity. But then he has to say, what price do I have to charge to get that 450? That I read off the demand curve. So he goes up to the demand curve and he charges that price. So in the imperfect competition, the equilibrium is marginal revenue equals marginal cost. You go up to the demand curve and you charge that price. Okay, now we turn to, so that's the cost aspect. Now we turn to, you don't have to follow me, coming back. Now we turn to factor. Okay, everybody got that?
Yes.
Got that? Good. Now we turn to factor equilibrium. And that's the last item on the list. And then factor equilibrium. And the question here is simply this: how does a company know how much of each factor of production to purchase? In other words, how does the company know I'm going to hire 10 workers and stop? How does the company know I'm going to buy 3 machines and stop? How does the company know where to stop buying workers, where to stop buying machines, where to stop buying each of the factors of production, each of the inputs? Well, again, we're going to have a little chart. The chart is really the mirror image of the cost chart, but it's worth it to put it up anyway. Okay, so units means units of labor, workers. 1 worker, 2 workers, 3 workers, 4 workers, 5 workers. Total product, 100. 220, 300, 360, 400. Marginal product means change in total product over change in units. In other words, how much product means how much, total product means how much 1 worker is producing for me, 100 bushels. 2 workers together are producing for me 220 bushels. 3 workers together are producing 300 bushels. 4 workers together are producing 360 bushels. And 5 workers together are producing 400 units. portions. Now, marginal product means how much that last worker is producing for me. So the first worker is producing 100. The second worker is producing 120. The third worker is only producing 80. The fourth worker is only producing 60. And the fifth worker is only producing 40. Because it's the change in the total product over the change in the units. Well, in my chart, the change in the units is always 1. So it's simply the change in the total product. Now, average product is total product over units. Okay, so the first line is 100, the second line is 110, the third line is 100, the fourth line is 90, and the fifth line is 80. Average product. Average product is total product over units. Okay, now, why, again, we ask the question, how come marginal product goes up and then goes down? Marginal product, you see, look, marginal product goes up and then goes down. Average product also goes up and then goes down. Why does this happen? Why does marginal product go up and then go down, and average product go up and then go down? Again, the reason is diminishing returns. And before the point of diminishing returns, product increases for each additional unit, and beyond the point of diminishing returns, product decreases for each. In other words, the first worker produces me 100. 2 workers together produce for me 220. What does it mean they produce 220? It means the extra worker produced 120. How does the extra worker produce 120? We said there's diminishing returns. We said each additional worker always produces less. We're before the point of diminishing returns. When you stick one worker in one corner and the second worker in his own corner, they may be able to help each other out, and the second guy may in fact be able to produce more than the first guy. So, before the point of diminishing returns, each worker produces more. Once you reach the point of diminishing returns, each additional worker produces less. And the average product simply mimics the marginal product. In other words, the average product simply is a reflection of the marginal product. Okay, so the average product also goes up before the point of diminishing returns, a little bit further as well, we won't get into the details, and then goes down. Okay, now again, factor equilibrium. Factor equilibrium is a simple question. How do you know how many workers to buy here? First worker produces me 100, let's say it's dollars. Second worker produces me 120, third worker produces 80, fourth worker produces 60, fifth worker produces 40. Let's say I say to you the price of each worker is 80. The price of each worker is 80. How many workers will you hire? The answer is 3 units, 3 workers. You will hire until the point where price equals marginal product. The same reason. If you're getting more from the worker, then in this case, the price is what it's costing you, and the marginal product is what you're getting. If the marginal product is greater than price, in other words, if the worker is giving you more than it's costing you, you'll do it. If the marginal product is equal to the price, you'll still do it. But as soon as the price exceeds marginal product, you will not do it because it's costing you more than you're getting, and you will stop. As soon as price is greater than marginal cost, you will not do it. So his equilibrium, factor equilibrium, how he knows how much of each factor of production to purchase, he purchases till the point where price equals marginal product. So if I tell you the price is 80, he only buys 3 workers. But 80 average product is all the way down here. Don't look at the average product. You never look at the average. You decide 1 worker at a time. Is the first worker worth it? Yes. Is the second worker worth it? Yes. Is the third worker worth it? Yes. Is the fourth worker worth it? No. The fourth worker gives me 60, and he's costing me 80, won't hire him. Even though the average product is 90, irrelevant. The fourth worker, caught he himself, is only giving me 60, I stop the worker bill.